In this video, guys, I want to talk about the market should never surprise you. Stay tuned. Hey traders, a very warm welcome to you. Alright, so this is something that I learned pretty early on in my trading career, and that is that you should always expect the unexpected, that anything can happen in the markets, and you start to see that as you start to put in the months and the years. You start to see stuff that no one ever expects to happen, and you start to see things that are supposedly 10 sigma events happening regularly. And so all this tells me, and all this tells traders who have been in the game a reasonable amount of time, and there's traders who have been in the game way longer than me, 15, 16, 17 years, whatever it is now, is nothing compared to some of these guys who have been in it kind of 40 years and they've just seen so many different types of markets. But anyway, the point is, even if you've been in for a few years, you start to see these huge moves or bizarre things happen that no one ever has thought could happen. And so what we should take from that as traders, and we'll kind of categorize the day traders, swing traders in a second, but the point is that anything can happen and you need to be prepared for anything. Okay, it doesn't mean that it's not going to be devastating if it happens to your account. I'm not saying that, all right, we need to be prepared every single time for that stock going to zero and be prepared to wipe yourself out. No, but the point is we should put it as a possibility and then decide what we're going to do. That's the difference. And so let's have a look at the scenario. So we have a stock or a market that we've gone into. We've gone in long, and let's say it's $100, right? We want $100. Okay, and we're expecting it to go to 110, and let's say we've got our stop at 95, for example, whatever it may be. And the market's chugging along. But before we take the trade, what can we do? We need to look at ultimately all the eventualities, starting from extremes and working in to multiple permutations of how it could get to 110 and how it could get to 95. So we've got the extremes first. We wake up one morning, it goes to $500. What do? Probably what we do is we close the position, unless the news says there's a bid for $1,000, in which case we wait for the 800 with the discount. You get the point. What happens if we wake up in the morning and it's trading at $10? Do we automatically close it? Are we going to look and assess? Is it worth it at that point? Do we need to assess and see what's going on? Maybe there's some decision-making process to be in place. The point is the likelihood of that happening is almost zero, but it will happen in some stocks from time to time, and you may well be in the stock it does happen to. You don't want it to happen. I'm not saying that you should plan for this, i.e., oh, I need to put my position size so small that if this happens, it's not going to hit you. It's going to hit you. It's going to hurt. It's going to sting. The point is, what do? You don't want to be stuck in a deer in headlights. And so you don't waste time on those extremes. You just have an idea. Then you start to work in. And the important thing now is you start to work in and say, what happens? Okay, what happens if I gap up maybe to 200? What happens if I gap down to 90? So you've got some kind of working a little bit, but the real juice is when you say, well, what happens if we go immediately to 110? Am I just going to close it straight away? If it goes to 109 straight away, I'm going to close it. If it goes within 1 day, what do? What about if it goes straight down to 96 and stays there? Do I need to add to the position? What do I need to do with that? And so the point is, guys, is that there's always something unusual that could happen in the markets. The market could go up to 109 the first day doing the trade, and then sits there and kind of settles around, and you might say, well, I give it 4 hours before I close it at 109 and say, I've got it so quickly, I'm not going to look for the extra dollar. Or do you tighten the stop up? What you don't want to be doing is making decisions when extreme events are happening. And I see this kind of quite a lot with traders who get caught out with unusual events, either for them or against them. If it spikes up immediately on day one to 108, you see that at the open, you take it. Maybe you should have been planning to say, well, why don't I see what's happened? Why don't I add a stop and think, well, if this is something bullish and it's a catalyst, this thing may well go to 125 now in the next few days. Maybe I need to reevaluate. Maybe I need to add to the position even. Maybe I need to be extra aggressive rather than taking stuff out. I'm not giving myself the opportunity to be in trades that are working very, very well for me. And vice versa. If it gaps down, our default as kind of beginner traders is to freeze and go, I don't want to crystallize that loss. But maybe the default should be to cut it straight away. Or maybe not. Maybe it is to to assess what's going on. Maybe it is to kind of add a stop a little bit lower. Whatever it is, the point is when it happens, then at least you're not surprised by it. You're not expecting these things to happen, but when they do, you're like, okay, that's what's happened. It's not a surprise. It's frustrating potentially if it's against you, or it's exciting maybe if it's gone for you. But I know, well, I've got a plan of action now. I know what I'm going to do. And then the less extreme things, like, okay, it's gone up my way. It's got my way 3 days in a row. It's kind of gone $4 or $5. What do I do now? Do I bring my stop up? How do I do it? What about if it spikes down really ridiculously intraday and gives back all the gains? Do I consider that as a... And so starting to plan these things out in the trade means that you're never surprised. You're never concerned about stuff. And yes, no one wants these massive moves against them. Everyone wants them for them. Of course they do. But the point is, it's never going to be a sudden shock that you don't know how to behave. You're stuck in a deer in headlights, and then you're trading on impulse. Because if you're trading on impulse, then you're not in a good position. And that could be on these extreme moves or the very, very simple ones. Think about Pilot, guys. You know, Pilot has engine failure in the cruise, for example. They don't expect it to happen. It doesn't happen very, very regularly, fortunately. But if it does, it's not a surprise. Like, oh, the engine's failed. That's not good. But we know what we need to do in that. Happens to be written down. We pull out with our procedures, etc., etc., etc. And they run through it, and they're minimizing the potential damage. Same with perhaps a positive thing. Maybe there's got a tailwind and again they get there quicker. It hasn't been planned for, or whatever that. Not necessarily the case, because obviously the weather's been planned for, but you get the point. They're going to adjust and adapt, and then it's not like, oh, what do I do now? I have to circle around until my time to slot is land. No. You know, they land, they'll make the call in, and etc. So point is, with trading, guys, we need to make sure that we have everything aligned, so that we know what's going to do, everything planned, so that we're never, ever, ever surprised by the market, because the market will surprise us if we're not prepared. Take care. Bye-bye.